The traditional model that has been very popular the last 12 years with value add multifamily is really an old model as we sit here today, because that relied on being able to take rents to a certain level pretty reliably and then liquidate a building by selling it or maybe refinancing it at that new level. And that model actually is not working today, uh, because several reasons. Rents, first off, are fairly flat across the board because of where interest rates are and because of additional supply that has come on when lower rates were lower. So today rents are not moving up much. But the other big part of it is the financing. Because of where interest rates are at, it's hard to put a back end value on what you're going to sell a building for today.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Jamison Manwaring. Jamison is a multifamily real estate expert and CEO of Neighborhood Ventures, a leading real estate investment company utilizing crowdfunding to enable investors to invest in multifamily properties. And in just a minute, we're going to speak with Jamison Manwaring about multifamily housing trends. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jamison Manwaring. Welcome to CREPN Radio.
Hey, thanks for having me. Good to be here this morning.
I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
You bet. I live in Phoenix. I've been here for almost 10 years. Prior to moving to Phoenix, I was in New York City. I worked on Wall Street as an equity analyst for Goldman Sachs, covered software companies, many of whom were growing very fast and going. We worked with them pre-public, and then once they went public, I covered them as an equity analyst. I would write the research papers about them and rate them buy, sell, hold. So when you hear, Goldman Sachs is upgrading Oracle shares from hold to buy, that's what I did. And so I got to know those companies quite well. When I was in New York, I was very interested in diversifying my capital, and I bought a small 10-unit building when I was living there. And I really enjoyed the process of buying a piece of real estate. We did some renovations to the property. We took the cash flow up, and the property I bought was in distress, so it was a great opportunity. One of the things I learned is you make your money at the purchase when you're investing in real estate, and so I got a great deal on that, and ended up planning to do some real estate on the side for the rest of my life, and then I ended up joining a company in 2015 in Phoenix, Arizona called LifeLock. They do identity theft protection, and I ran their investor relations. And we got bought out a few years after I was there. And I had the opportunity to decide, do I want to stay in corporate finance and in public equities, or did I want to do a transition? And at that time, I ended up meeting my now co-founder, who was a 35-year multifamily expert in the Phoenix area. And we decided to launch Neighborhood Ventures. And that was 7 years ago. We in that time we've done now 17 offerings of different projects. We buy older multifamily buildings and renovate them. We also bought new 24 townhomes right in Phoenix that were, you know, built in 2018. We raised the capital, we manage those and own that asset. And together we work well. I focus on the financial aspects and raising capital, working with investors, and my business partners just has a lot of depth in the real estate space. Um, One of the cool projects we did is a 120 unit hotel to multifamily conversion in Mesa, Arizona, and we operated it as a hotel for a while. Then we got the approval from the city to convert it to an apartment building, and that's just recently been going through lease up now. And so that was a great fun project. Added 120 new units to the market, which the Phoenix market needs more housing. So that was a great win. So we've done some fun projects, and we're doing some fun stuff right now too. So um, happy to talk about kind of where the market's at, and I think my experience in the public equities has definitely given me a different view than someone who's always been investing in real estate and kind of cited to real estate, because I saw how quickly software stocks go up. They also come down really quickly. And I always gravitated to something that was more steady, kind of linear. And that's why I ended up in real estate. And I enjoy it a lot more than I enjoyed it those roller coaster days of software stocks.
Yeah, I appreciate you taking us through that. Sounds like you've had some little hands-on kind of by yourself, and then grown into some bigger opportunities there. That's neat. Um, so tell me about Neighborhood Ventures. How deep do you guys go? Uh, do you do? I mean, you mentioned investor relations and raising capital in that, and some of the projects you're involved in. Do you guys manage the properties internally? Do you have contractors that you uh, work with directly, or do you do that internally? How do you guys work on all that?
When we first launched, and it's been 8 years now because we launched in 2017, we it was just me and John. So we did a lot of outsourcing. We wanted to do our investor relations and build our investor relationships internally. So we always raised our own capital. We would talk about the project ourselves. We would walk through the property with investors and spend time going through units with them, helping them understand what our plan was. At the time, we were doing value add properties. So our first building was a 10-unit building in Tempe, Arizona, right next to Arizona State University. Needed to be renovated. And it was fun to be able to be really hands-on, to meet investors at the property and say, hey, this is what it looks like now, and this is what we could do with it. And this is where rents will go when it's renovated, because people are happy to pay more for a renovated unit that maybe it has laundry now in the unit and has a renovated kitchen. So we did all that hands-on and learned a lot through that process. And then we initially had contractors doing the work and doing the property management, because at the time it was just John and I. And by the time we got to our fourth project, we had brought all of the renovation work and contracting and construction in-house. John had a pretty deep background managing that, and knew people who we wanted to hire internally. So we brought that team in-house next, and that worked well for us. We had a third-party property manager who partnered with us, and then as we rolled in, and it was by about our 13th project, as we started doing the lease up after the building had been renovated. I wasn't real happy with how the lease up was going. I didn't feel like the third party property manager was focusing on it the way that they could be, and then the way that we would if we were doing it ourselves. And so we decided to bring third party property management, or to bring property management in house as well. And one of the challenges that the Phoenix market has had over the past few years is we've had a lot of new supply of new construction units come online in the last 3 years, including 2024. We've had about 20,000 new units come on, beginning in 2023, then again in 2024, and then we're probably going to get that number again in 2025. We've had a lot of new supply come on the market, which means renters have a lot more choices. And if you're not managing your property well, if you're not answering the phone when a potential tenant's calling, if you won't go show them a unit on a Saturday afternoon, you're going to lose that potential tenant to someone else. And so we brought all of our management in-house, and our buildings have remained full. Our tenants are having great experiences. And I know friends in the business who use third-party managers, and they are getting very subpar results because it's a different market. It's hard. It's a harder market than it was a few years ago when you could just put the listing up and it would get filled immediately. So now we're to the point where we do everything in house. We do all our investor relations in house, all our construction and property management, and I wouldn't have it any other way. We want to deliver a great experience for our tenants, great experience for our investors. We want to have a building that when we're ready to sell it, we know exactly what's going on, and we can, hand that over to a new buyer with full confidence in how a property's performing. And by doing everything in house, we feel like we can do all of that very well. And you also learn a lot when you're doing property management, that if you're not doing it, you don't really know what's happening in the market as well. And so it's much better outcomes, and it's much better intelligence as well, which is really critical today, in a market that's a little bit more challenging when it comes to multifamily. To have that insight leads to better decisions on our part.
Yeah, I appreciate you taking us through that. And the insight you talked about that, by having it in-house as opposed to relying on a third party. Um, I'm, I'm a small-time investor, but I've dealt with that just with property managers. The message gets diluted, and then you talk to somebody else, and 3 people later, it's not the message you started with, and just all the time loss. Nobody's understanding that we're talking about time equals money, kind of thing, and the frustration, like you were talking about, just the challenging mark with all the new supply. About if you're not willing to meet the customer when they're available, you're likely not you're gonna miss out, kind of thing. So
And it's a tough job. It
yeah.
is not an easy job. You need to have highly skilled people on your team. You need to have people who believe in the product, that really that care about those tenants. They need to have high emotional intelligence, because they're going to have tenants who put a lot on them. Some days they'll get yelled at for nothing that they can control, just because tenants take it out on them. And so it is the most critical piece of the operations that needs to be done right. And we decided we wanted to tackle that to ensure that we did that at a high level. And it isn't easy to do, and that's why a lot of people put it off, and they want to kind of have this false sense of security that my property manager is going to handle that for me. I don't have to deal with the weekend calls when there's maintenance issues and, tenant issues. But we decided we wanted to have a better overall outcome. And so we decided to bring it in-house, and I'm really happy we did.
Yeah, I appreciate you sharing it. Um, I wanted to ask you, you mentioned the supply in Phoenix, the market there. You mentioned 20,000 units. Is that annually? You mentioned like 3 years that there's uh, a bunch of supply coming on. Is that 20,000 per year, or is that 20,000 over the 3 years?
It's 20,000 annually,
Okay.
which is a pretty astounding number. We were the number one market for new units in 2023 with just at 20,000 units. The demand in Phoenix for new units remains high because 100,000 people move here every year, and that 2024 number just came out that we had another 100,000 people move to Maricopa County, which is the Phoenix metro area. 100,000 people moved here in 2024, so we have a lot of growth here. But our demand has historically been 8 to 12,000 new apartment units are needed just to keep up with demand. And so when we saw 20,000 units come on in 2023 and then another 20,000 in 24, there is a lot of new supply coming on here. The silver lining to that is our growth has been strong, our population growth, job growth. But as we get to the end of 2025 and even to the back half of 2025, the delivery of new units is really falling off a cliff because these new construction developments are all being put on hold. Anything that's started, they're trying to get completed. But with interest rates being where they are now, new projects do not make sense with these current interest rates. The cost of construction has gone up a lot. So the average cost of construction for apartment unit is around $350,000 for a 2 bed 1 bath new out of the ground. Um, so it is not cheap to build these things, but the projects that were planned when interest rates were low, those are getting finished, and it does take several years for the that conveyor belt to get completed. And then as we get into 2026, 27, 28, we're going to have a shortage of new construction, and the demand we expect is still going to be strong. And that's when rents will move up. And rents have been flat because of all this new supply the last few years. So there's definitely going to be a kind of a pent up demand to raise rents. And I think that the market can absorb that. But yeah, it's a lot of new units that have come out the last few years, and a lot of developers said, "Hey, Phoenix is a good place to get to build. It's growing. Property taxes are good. It's a friendly landlord state." And so we've got a lot of new supply the last couple of years here.
When you mentioned a couple of things that are always important, you've got inward migration, 100,000 a year. That's strong. What about job base? Is there a particular sector? Is it tech? Is it military? I can't remember what drives the economy in Phoenix.
Yeah, Phoenix has always been, 20 years ago was heavily driven by construction, by growth, by immigration. You have a lot of retirees here. But we talk about the 4 Cs or the 5 Cs: citrus, cotton, construction. I always forget one of them. Um, but the economy has changed in the last 20 years here, and even in the last 5 years, because of the focus on semiconductors. And TSMC, Taiwan Semiconductor, is building their largest US based plant in Phoenix. The last I heard, the number was $60 billion that they are investing in their plant. And this is a long-term 30, 40-year project at least, where they build different fab plants, and once one's done and it's up and running, they have thousands of acres to add additional plants. So and Apple uses TSMC. It is the world leader when it comes to semiconductors and chips. Intel is also here, and they're also a big semiconductor chips producer, and they have a big footprint here. And so it was already um, heading in the direction of being a great place and kind of a hub for the semiconductor industry. And now, when TSMC in the last 5 years, as part of the Inflation Reduction Act and the CHIPS Act, the U.S. government is co-sponsoring a lot of this investment in Arizona, and it is changing the economy here. And you also have to remember that not only is it the tens of thousands of jobs at TSMC, but it's all the suppliers who are now locating here to support them. Similar to how in Detroit, you have the automakers, but then all around there you have all of the part suppliers and that whole ecosystem that extends, throughout Michigan and the Midwest to support that industry. And that has become clear that semiconductors and that whole industry is if not the biggest hub in the U.S., one of the biggest hubs is now in Phoenix. We don't have natural disasters here. Knock on wood. We don't have. We avoid tornadoes. We avoid um, uh, hurricanes. Big snowstorms hit us or miss us. And so companies like TSMC gravitate here. We also have a 100-year water plan. So even though we're in the desert, we know what we're doing for water for a long time. Um, and that gave TSMC the confidence to make this huge investment here. So we've kind of matured from construction heavy and growth heavy sort of trades to more of a deep rooted engineering skill set sort of workforce that's now coming here. And so you see as that plays out over the next 10 or 15 years, it's really going to change the workforce. Higher wage jobs, jobs from Arizona State are more engineering related. Arizona State produces more engineers than anyone in the U.S. now, which is part of why TSMC is here. So it's headed in the right direction when it comes to our workforce.
That's impressive. And also with having multiple chip manufacturers, I mean, large brand chip manufacturers there. I know, just having the pool of talent there that, that both employers can seek and the employees will, I mean, just have that good population base of talent. Talent needs housing. There's jobs. I mean, that's a nice balance to have there. That's good.
And when you think of the 100,000 people that moved here last year, not that many of them came here to work in the semiconductor industry. There's already just kind of a natural growth and migration here from people who want nicer climate. That's the other C that I didn't mention before is climate. Um, and they want sunny skies and they want a better lifestyle. So those people continue to move here, and now you add on top of that much more educated and high-paying base of people who are starting to come here and will be coming here over the next 15 years as the semiconductor industry really matures here. It's going to be interesting. It's going to be most people who see what's happening here, they drive by that plant out in North Phoenix. You can see that uh, there's going to be a lot of growth, and we have momentum here in Phoenix.
You mentioned the water plan for 100 years. I'm not familiar with the land use laws in Phoenix. Are there any restrictions or anything that would prevent the growth from continuing to grow? I mean, is it growing out into the burbs, or is there more of a limitation on space?
Well, the interesting thing with water here is, our population in the Phoenix metro area is now around 4 million people, and we use less water in Phoenix Metro now in 2025 than we did in 1955 in the same area with 500,000 people who lived here. And the reason is because we've gone from heavy agricultural to more of a city and an urban feel. And anyone who's driven around Phoenix from the coasts, uh, one of the things you first notice is that the yards have a lot of rocks in them. There's not a lot of lawns here. We don't try to do too much when it comes to landscaping because we know we live in the desert, and the way that people build and the way that the cities push proper development is we don't use much water for things like that. Now there are a lot of swimming pools here, but there's also a lot of restrictions about how that water's stored and used, and if you hit a certain max, then a certain amount, then you're going to pay more. So that tends to fall on higher income people. But water usage, it's pretty incredible. Is actually less than it was when Arizona was, a fifth of the size population wise. So we have a lot of great conservation in place, and we get most of our water, much of our water from the Colorado River, which is also shared with California. And we have big reservoirs, Lake Powell, Lake Mead, that we tap into. Um, it's always a concern when we meet with out-of-state investors, but the planning, it is the number one thing that's planned when it comes to infrastructure for Arizona, and we have a long-term plan that to continue to tap into those water sources, and then we continue to conserve and be smarter about how we use it. New developments, there's not a lot of there's a lot of restrictions on how they can use water, so that we make sure that we get through and hit our targets in that 100-year plan.
No, that's important to have a plan when you're in the desert and water. That's good. So talking about trends, we talked about the employment trends, population trends for Phoenix. We talked a little bit about the new construction trends. How do you see the position where Neighbor Adventures is with the value add? Do you see the supply of these opportunities continuing to develop, or do you see the demand for not the new, but I'm assuming it's well located, or what it is that you guys are focusing on? How do you see the kind of that not the new construction but the existing construction demand high for that? Can you speak a little bit about the demand for that kind of a product as opposed to the new?
The traditional model that has been very popular the last 12 years with value add multifamily is really an old model as we sit here today, because that relied on being able to take rents to a certain level pretty reliably and then liquidate a building by selling it or maybe refinancing it at that new level. And that model actually is not working today because several reasons. Rents, first off, are fairly flat across the board because of where interest rates are and because of additional supply that has come on when lower rates were lower. So today rents are not moving up much. But the other big part of it is the financing. Because of where interest rates are at, it's hard to put a back end value on what you're going to sell a building for today, because the apartment market is just in a weird spot with 7% rates, 10-year at 4.5, equaling most loans around 7%. It's hard to determine what is my exit cap rate going to be to make a value add play make sense with where current interest rates are. So there's a lot of assumptions on a value add deal today that don't make sense to me. I mean, there's a lot of unless you're buying a value add deal at a really, really low attractive entry point, um, and that you can assume that interest rates are going to be the same in 3 or 4 or 5 years when you sell it. That's the only thing. That's the only way to me value add makes sense. Um, the new buildings that are coming out and being completed, there are a lot of investors that are happy to gobble those up, especially if they're larger investors at a pretty attractive cap rate. 5% is still kind of the institutional level. Most new buildings are being able to be sold for that if they are over 100 units or larger. But uh, even if it's smaller in the more mid-size or small, um, it's difficult to on the value add to say I'm going to take a building, 1950s, 60s, 70s, 80s, renovate it and get to the spot. It's not where we are today. And we've underwritten many deals trying to see if it could make sense on value add, and nothing has made sense so far. What does make sense and what we are doing is we're buying buildings that are in some level of distress. So an operator got raised capital to go do a value add building. They were thinking rents would go here. Instead, they went here. And now their loan's coming due, and the lender is either not renewing their loan, or if they want to get a new loan from the lender, they're going to have to come up with a lot of cash to do a debt buy down, which they don't have. And so we're seeing many buildings, I won't say many, we're seeing some buildings come online in this situation. Either they're pre-foreclosure, they've been foreclosed on by the lender, um, or now they're lender owned because the lender's taking them back, and those lenders want to get them off their books. So that's where I see the opportunity today. We're in a cyclical industry with ups and downs, mostly driven by what interest rates are doing. And so as interest rates went from 0 to 5% in an 18-month period, a lot of things changed for people who own real estate who expected those rates to stay low. And those are the types of opportunities that I think make the most sense for investors today.
When you speak of distress, is it primarily financial distress that you're seeing based on the seller's position?
Primarily, yeah. They need new fresh capital, and they can't handle the current debt service. In some cases, like one building that we have in contract right now, that we're buying 123 unit in Phoenix, they're at about 75% occupancy. So it's mostly financial distress, but they also operationally have not been able to lease up to get to where you want to get to. Around 95% occupied for multifamilies is our average in Phoenix. So they were well under that. So as we buy this building, we're bringing our team in. We're going to get the remaining units leased up. That is job one. And then stabilize the asset. We bring in new capital. We have a much lower debt burden. Property will cash flow, and they just expected things to keep doing this. And anybody who has been in real estate for a few cycles knows not everything moves up all the time. There are some pullbacks from time to time, and that's where we're at right now. So as investors, we have the opportunity to take advantage of that right now.
No, that sounds attractive. If you're able to, acquire a property at a price that reflects the operations at 75% occupancy, and you're able to, push the occupancy up to 95 or plus.
And we're purchasing it directly from the lender
Yeah.
for the debt amount that the prior owner had as a debt amount. So they had 13 million in debt, and they had raised 4 or 5 million from investors. So the total value was around 19 million. We're buying it now at 13 million from the lender directly, 2 years later.
Yeah.
It was a very difficult deal for us to source. When the lender took it back, we had some long-term relationships with some people involved with that lender. We were able to reach out and say, "Hey, we'd be happy to buy it." Started negotiations. We have a fund, an opportunistic fund that we had raised, so we were able to say, we can close in a couple weeks, and that's how we won the deal from the lender because the lender didn't want to manage it long term. So it was a win-win for both of us, and it's a great opportunity for us and our investors to buy an asset at 105 a door, 105,000 a door.
Yeah.
And if you remember what I was referring to earlier about building new, to build a
300
new
plus.
apartment building is about 350 a unit. So to buy it at 105 a door, um, you're getting in a really good entry point.
So when you in those types of situations, I'm assuming you use the bank for the financing, or do you provide your own financing? And is there
For them, they would rather just get it off of their books. So
there-
we talked with them about that, but we're bringing a new loan in
okay,
with a new lender, and then raising our own new equity as well.
okay. No, but still, just that price point. Um, I'm assuming you're even with a higher interest rate, uh, your debt coverage ratios, if they work from day one, they're going to work great as you go forward and fill up the building.
You're
And
exactly right. And
what?
if you can make things pencil today, like you're saying, if it makes sense from a debt coverage ratio today, and we can get better occupancy, and we do expect rents to start to move up over the next few years as well, as all this supply gets absorbed and no new supply comes on, very little supply comes on, which is what it is looking like, then you're in a really good position. And you've hit it right on. We also expect interest rates will probably go down a little bit from here, and that will be additional upside. But we're not banking on that. That would just provide a little more upside even than what we're planning.
Yeah, but I mean, to look at it from where you guys are at as opposed to where the seller, you know, I'm assuming they had a great plan and back when they acquired it, obviously the game changed with interest rates increasing like they did. Um, what one of the challenges I think that I've had to kind of reconcile in my own brain is that a lot of the opportunity is in the chaos. And as much as I think most of us like some sort of an orderly plan for our own personal finances, it's that dynamic marketplace that creates the opportunity. And the hope is you're not the one that's holding the loser when that happens, but you have the dry powder and you're able to take advantage of an opportunity like you guys are doing. That's exciting.
Yeah, and I've been in this space now for 8 years, and in that whole time, there was never a value on an apartment building in Phoenix. You were happy if you could get a 5% off of the list price. So I'm excited to be able to buy some assets at a good value. At my heart, I'm a value investor. I'd love to buy stuff cheap and run it well, and then you can liquidate it when things turn. But um, it's been a bull market for 15 years, so at some point there's going to be a correction, and so we're trying to take advantage of this window that we're in right now.
No, that's great. What kind of terms are you able to get on new purchase like you're doing here as far as the length of the amortization and that?
We have a few different options on this acquisition. We do have some banking relationships that we can get a regular bank loan at 60% loan to value. Um, that rate's about 7%, and so that's an option for us. Um, we can also get more, closer to 70% loan to value with a fund, a debt fund sort of structure. And that's about 8.25 interest rate, interest only. Um, and our plan on this building is a 3-year hold period. And then at that point, we expect to sell it to the next owner. We're coming in the distress situation, getting the asset turned around, getting it operating at a high level, and then we'll liquidate it once it's at a higher level and the market's in a more rational place. So that's our plan. And so we'll choose one of those debt routes over the next few weeks before we close. We're set to close early February.
Yeah. Well, typically, your hold time, what kind of a hold time do you usually shoot for?
An asset like this, it's a 3-year period. We expect within the first year to get it up to full occupancy, to get it running it at a high level operationally, and then let us run it for a while. We'll start sending out distributions to investors in the second year and third year. And where we're at today, we think things are going to look quite a bit different in 3 years. So we're expecting to have it fully liquidated in a 3-year term.
Yeah. Well, with that kind of a short hold time, that IO option, I would think that would be a pretty, I mean,
Yeah,
just from what you've described there, 70% versus 60% and interest only, and plus you're starting at such a low occupancy. I mean, I'm not the sharpest tool in the shed here, but that one looks like it makes sense. So,
yeah. It actually doesn't take a genius to see that.
yeah,
The hard part of this is acquiring the asset, finding these right now, because we're not in broad-based distress like we were in 2010.
right.
Most operators have figured things out, and most of them have deep pockets. We're dealing with some just in Phoenix. There's been 5 assets that would fall in this category that are in our mid-market range, 50 to 150 units, and we've taken a run at all of them. And the property I was touring this morning is another one of the 5, and then we have this one that we're closing next month. So not a lot of these come on. They're hard to find. And then the second part is our operations have to be top notch. You have to have great people running the property management, maintenance, financial operations, so that tenants stay, so that we keep the property full, that we can take rents up as the market moves up. So we got to have good operations, good team.
So you've talked a little bit about interest rates and how they affect deals and that. You, you've kind of hinted that in different parts of this conversation about where you expect things to be, but in the next 5 years, do you have any kind of a sense? I mean, nobody's asking for your crystal ball, but just based on cycles, um, and do you have any sense of what interest rates might look like here in the next 3 to 5 years, based on what you're seeing?
Yeah, it really depends on who you ask. There are a lot of people, economists who I follow, who think that the 10-year really needs to be around 3%. Today, where we're sitting, it's about 4.5%. And these economists think that in order to be in a accommodative market, the 10-year really needs to be around 3%. Right now, the Fed has indicated they're in a restrictive environment, so that they have interest rates elevated to slow down economic growth. An accommodative market is kind of neutral. So it depends on who you ask. There are some people that think interest rates right now are more accommodative, more neutral, and that's a target that can move. That goalpost isn't set. So we will see how that plays out. But I would say for an investor or an operator, um, we don't expect interest rates to go down from here. You have to underwrite your properties at the current rate. I don't think that they're going to go up from here. If they do, not much, because they've gone up a lot. Inflation's now under control. We haven't quite got to the 2% target, but we're getting close. And I don't expect interest rates to move up a lot from here. like they did in the early 80s when inflation just kept going. So when you think about interest rates, it's not really about who the Fed chair is or where what the um, the president's saying. It's really about inflation. So you have to look at where inflation's going. Inflation is uh, coming down, but it's still not where we want it to be. So it needs to be at 2%. That's the Fed's target. And so I think as an operator, you have to just work under today's environment, and then that gives you upside if things get better.
Yeah, no, well said. Hey, Jameson, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, could be the Fed, investors, tenants, the market, supply, however you identify and whatever you identify to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Jamison Manwaring, what is the biggest risk?
The biggest risk that I see today is continued oversupply of housing, and we always go back to Econ 101 that it's supply and demand, and we have a lot of demand in our markets that we cover for housing. There are not enough people who can afford to buy a home, so more and more people are renting, but we've built a lot of apartments also. So if the supply of new apartments is stronger than the demand, then price either stays the same or can potentially move down. And so as I'm looking out the next few years, it really is when this new supply starts to go away and we get to more of an equilibrium with our supply and demand. The past few years, the biggest risk has been what would happen with interest rates and where do we land? And I think now we've kind of gone through that. Right now, what I'm looking at is future supply, what will happen in 2025. And as appears right now, 2026, 27, 28, the demand, the supply falls off a cliff. I do think besides the supply, what happens with insurance is a hot topic right now because we just saw what happened in with the fires in California. We're having a big blizzard right now on the southeast that is freezing people and it's going to cause problems. And insurance is, and some people think insurance is kind of a broken model when it comes to commercial real estate and and how you make insurance work. In some cases, when you buy an older building in Arizona, you might get one bid from an insurance broker, and that's all you can find. One company who will put insurance on the 1960s building, even if the building is all up to code and has updated electrical panels and other things. Maybe one person, so one company. Where 6, 7 years ago you'd have 3 or 4 quotes. So insurance is in a really precarious spot, and I do know it's hard in some places to get insurance in Florida and Texas with the hurricanes and now with California. So that we think it I think it'll figure itself out. Um, and whether that means higher premiums or adjusting risks in other ways so that there'll be a marketplace. But it is definitely a hot topic and something if you're an investor or an operator, you need to stay on top of because it's a changing landscape right now.
Yeah, amen to that. You're sounding kind of like me on the other end of the phone with a lot of my clients right now. It's it's a tough market with the insurance, and fingers crossed they start making money and more competition comes back into the marketplace. Some of these challenging asset classes and markets, but not holding my breath.
Yeah,
But,
and ultimately they have to make money, so
yeah,
premiums are going to continue to move up, and we've seen premiums move up already the last few years, and they're probably going to be keep moving up until that equilibrium comes out. So that's an expense you have to be ready for.
yeah, that is. Hey, Jameson, where can the listeners go if they'd like to learn more or connect with you?
So our company website is neighborhood.ventures, or you can just put neighborhood ventures in Google. You'll find us. We do a lot of content, a lot of educational articles and videos, podcasts like the one we're doing today, which appreciate you guys having us on. You can find access to all of those on our website or YouTube. So we're pretty accessible. And the cool thing is you can also see how our fundraising is currently going on our current project, Venture on Coulter, which I referred to. We're 89% funded at our $4.5 million target or max. We're already closing on that project, so we have funds to close, and then we'll continue to fundraise, and I'm quite sure that one will be 100% funded here soon. So you can see that all on our website. We keep it very transparent. As you mentioned before, we do crowdfunding. So in order to invest with us, you either have to be an Arizona resident or an accredited investor to invest in Venture on Coulter. We also have a REIT, which is open to anyone nationally, accredited or non-accredited investors. So we have some cool products and opportunities for people to invest in what we're doing.
Awesome. Well, Jamison Manwaring, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I learned a lot and look forward to doing it again soon.
Yeah, great to be here. Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.